right, it's your time.
Get everyone here.
That other stuff, really.
Well, I want to thank everyone for coming out to our lunch and learn today. We're going to have hopefully an enlightening conversation today on an important topic, business topic, cash. For those of you who don't know me, my name is Chris Smith. I'm a CPA and owner of C.B. Smith & Associates. We were established in 2003. We focus on servicing businesses and are located just north of the square in Cumming. We have 14 employees. You can say hello to all of them today. They're here joining us. We appreciate you coming out, especially you folks that are clients. This is our way of just saying thank you. Thank you for being clients. Before we get started, I'd like to take a moment to thank Q Barbecue. They're located off Highway 20, just down past the Nissan dealership on 20. As always, they've got delicious food. If you are thinking about one of those power lunches here in the coming area, go ahead and think about Q. They're a great place, a good place to meet people and enjoy some good barbecue while you're at it. I'd also like to take a moment to thank Pete Winkle with Winkle Photography for chronicling our event today with some of his photography. We hope to post and share some of the photographs for today's event on social media, so please follow us, like us on Facebook, LinkedIn, Twitter, and hopefully you'll see some photographs of yourselves. And be sure after the event, we've got all kinds of little props there. You can show that you're interested in cash as well. Okay, so we decided to have a little fun with that. But today, I brought together a panel of experts, the type of advisors you're going to want in your business. And I'd like to take a moment to introduce our panelists today and our experts, and they're going to make me look good. So. I'd like to introduce David Hogan. He's a commercial relationship manager with United Community Bank. He's at the branch here in Cumming off of Marketplace Boulevard. David has more than 15 years experience in banking industry, including 6 years commercial lending with United Community Bank and previously Georgia Commerce Bank. He was also vice president with Patriot Bank of Georgia for 5 years and spent 4 years as a client advisor in the private wealth management healthcare division with SunTrust Bank. Dave's previous background is working in corporate accounting, small family business, and real estate investing. He sat on both sides of the closing table and has run small businesses much like his customers. This experience gave him insight to help his customers in banking as a banking partner. His banking career is non-transactional based. He's built long-term relationships with his customers. He has a bachelor's degree from University of North Georgia in accounting. So it's a strong accounting background. Drew Tosmeyer, right here, he serves as the area director with the University of Georgia Small Business Development Center at Kennesaw State University. The KSU SBDC was recognized by the U.S. Small Business Administration in the Southeastern United States is the winner of the SBDC Excellence in Innovation Award. Drew has more than 21 years experience within the UGA SBDC organization. His consulting expertise in strategic marketing, financial packaging, overall business management has impacted thousands of business owners. His background includes service as president and CEO of the Cartersville-Bartow County Chamber of Commerce, as well as experience in retail, manufacturing, and service environments. He has tons of accolades from the UGA SBDC, including Consultant of the Year, and has held numerous leadership roles in the organization. Drew has his MBA in Marketing from Georgia State University, his BBA from the University of Georgia in Marketing, and his associate's degree from the Oxford College of Emory University with an emphasis in business administration. I'd like to thank you both for coming here today.
Thank you, Chris.
Yep. All right, so my goals today are first and foremost not to put you to sleep now that you got a bunch of barbecue and stuff. Okay, secondarily to have an insightful discussion on cash and cash management, and hopefully leave you with a better understanding of what you can do to improve cash management in your business and improve your cash position. Okay, are we ready to talk about some cash? Yeah. All right. Cash is key to the success of your business. That's why you often heard. Okay. Today we're going to talk about cash flow, why you need it, how to manage it, and how to improve it. So, what is cash flow? Okay. Cash flow is the amount of cash or cash equivalents you either bring into your business or you flow out of your business. It doesn't matter whether it's an expense, an expenditure, an investment, borrowing, or even a distribution. Cash is the lifeblood of the business no matter what size. Okay? It's so important, it can break your business. That's why accountants, bankers, and investors look very closely and have a close eye on the cash flow of the business. It's funny, all too often in reviewing tax projections with our clients and tax returns, I get the question a lot. If I'm making so much money this year, where's the cash to show for it? And so hopefully today we'll be able to answer some of those questions for you. All right, cash flow. For me, that's the first thing I look at when I'm looking at my client's financial statements. It's a critical part of the business. As a matter of fact, it's the most critical part of the business, over and above the profits in the business. I'd like to take a few minutes to maybe let our panelists here share some of their thoughts on what cash flow is to you in your day-to-day operations and your day-to-day activities when you're dealing with some of your clients. David, why don't you share some of your thoughts?
Okay. Well, a lot of people focus on, I've run $1 million through the bank this year, but $1.2 million has gone out. And understanding why $1.2 million has gone out is important, because what a lot of people fail to look at is the total cash flow. They look at the profit and loss without accounting for debt repayment, capital expenditures, investments in new equipment for growth in their business, which can really affect their ability to continue operating their business.
Drew, when you're working with some of your clients and advising them, what are some of the key aspects of cash management that you focus with them on?
Well, how many of you have an account called loan to customers, also known as accounts receivable? That's what that is. And so that's usually one of the first places we go and look on. What is your accounts receivable policy? Are people paying according to the terms that you agreed to? The secondly is, did you even do a credit check on those loans that you're handing out to your customers? Are they credit worthy for those loans? So that, for those of us that have those accounts receivable, that's the first place that it starts, is because that's what that is a loan to customer. You're loaning your money for 30, 60, 90 days or longer, and say, how do you do that cash cycle? So that's one of the things that we look at, is the cash conversion cycle. Is days outstanding in accounts receivable, days payable, and then what is the difference of that cash cycle?
That's an interest-free loan, too.
Interest-free loan.
Thank you. All right. Before we get into any questions and answers, what I'd like to do is spend a few minutes to set the stage a little bit, get us all in a frame of mind so we can think a little bit about cash management. I think that'll be helpful, and then we'll have some time for some questions as we end this session here. Cash management. Cash management is the process a business follows to provide and maintain adequate liquidity in the business. The question is, what's liquidity? Liquidity is the business's ability to convert assets into cash. And it's so critical that you have that liquidity out there. All right? So if you have inventory that's collecting dust on your shelves, that's a sign of poor liquidity. If you have inventory that's moving fast, the business has good characteristics of high liquidity. Anything else you guys want to maybe type that on? Liquidity, cash?
Back to his AR statement. Exactly the same thing, liquidity.
Days outstanding.
Are you going to talk about a quick ratio? How many of you ever look at your balance sheets and do with this thing called a ratio analysis. And one of the easiest ones to look at is what's called your quick ratio, which is looking at your current assets divided by your current liabilities. And that is the measure of liquidity. Right there is, will tell you, is it 1.1? Is it 1.9? Is it 2.4? And we get that question and go, what should it be? And it's different for every business in every industry. But that's one of the quick measures you ought to be looking at on your balance sheet is, how is my ability to pay my bills over the next 30 days matching up? How has it changed over time? And that way you can plan for these capital expenditures, because that's going to drain some cash out. And that could impact your future 30 days that you have in your cash cycle.
Yeah, it's quite possible for a business to have a lot of debt on the books, but still have high liquidity. They've been able to structure their debt in such a manner so a certain portion of it's long-term versus short-term. And if they have the flow-through in their business in terms of sales and inventory pushing through in their business, they're in a position where they can continue to service that debt and still maintain some liquidity. All right, things to consider in cash management. First and foremost, you want to consider the type of business you're in. A healthcare organization is going to have many different characteristics and challenges related to the cash management than a convenience store. Very different. And so you need to understand your business. You may be in the retail business, distribution, services, manufacturing, maybe a combination of retail and services. And all those aspects of that business are going to, you need to bring them into consideration when you're understanding your cash management from that standpoint. Understand also the concept that we're going to talk about today, inventory. Health organizations probably not going to be worried about inventory. But a convenience store, it's a big deal for them, especially the fuel. Very big deal for them. So each situation is unique, and I can't be remiss in saying, consult a professional, get their advice, pay them to educate you so that you can make good decisions in your business. And no matter whether it's a banker or someone with the SBDC, or of course an accountant. So. All right, statement of cash flow. You'll find on your table here statement of cash flow. Professional accounting standards. As an accountant, I'm required to present the financial statements in a certain order. And that order is we need to present the balance sheet, an income statement, or some people refer to as a profit and loss, and then the cash flow. My personal preference is that the cash flow should go first, the balance sheet should come second, and the last thing you're looking at is the profit and loss. And how many times as business owners you get your financials and the first thing you do is you jump right up to that income statement. How am I doing? Yep. Right? But you got to understand, when you're thinking about cash management, there is two distinct measures you have out there, and they are not related to each other. Cash flow and income are not related. Okay, income influences cash flow, but there's too many other factors that affect cash flow, and cash flow is the thing you're going to want to look out for. There's so many businesses out there, there are profitable businesses in history that have filed for bankruptcy. You can be profitable and just file and end up having to close the doors because of your inability to manage the cash in your organization. So in that cash flow statement, we got 3 different categories of cash flow. All right. The first category you'll see in there, I'm going to grab one of these here, is cash flow from operating activities. And you can see the first line of that cash flow statement is net income. So certainly income does influence your cash flow. It's a starting point. But in this case, with Greg's Donut Shop, he's asked that question. I've made some decent money. I've been open a year or two. Why don't I have any cash? I started with $22,000 in cash in the bank, and now I got $14,000. So Greg's been growing. And so consequently, Greg's had to bump up his inventory. He's got this special chocolate sauce that he gets from South America. And it takes him 2 weeks to get it. And so he's been selling these chocolate donuts like crazy. And so he's got to order it from South America, and he's got to order a lot of it because he's continuing to grow. His business is growing. And so consequently, right here in this cash flow statement, you'll see starting off with $67,000 in income, yet he's got a large cash outflow of $19,000 because he's having to grow his inventory so that he can continue to sell those donuts that he has up there. The other section we have in there, so from an operating standpoint, a reflection of the operations of the business, he may have made $67,000, but his cash flows from the operations of his business were only $44,000. Then you got to consider, well, he's been stamping these donuts with a hand stamper, and he's selling like crazy, and he's going, my arm's getting tired, so I want to go out and get a 5 donut stamper that's got hydraulic stuff going on, and it's going fast. So he says, I got to go out and spend $21,000 to get that piece of equipment so I can continue to maintain the growth of my business. And so, he's stingy. He doesn't like getting in debt with the bankers and stuff. And so he's decided that he's going to go ahead and buy that with some cash. And so there's a cash outflow in the business. So those profits have been, slowly paying for those investments. That investment he's made in that business, a long-lived asset. It's not going to be in the income statement. That's something because he's going to use it for the next 10 years. We're going to slowly expense that out in the income statement because that's what accountants like to do. Investors don't always like it that way, but that's the appropriate manner to handle that. And then finally, he does have some of that debt to the bank. And he's going, I'm making some money, things are rolling, I'm pretty happy. I don't like that debt, I'm going to start accelerating my debt payments. Get that loan down as much as I can. So I'm going to go ahead and spend an extra $20,000 over my normal terms of the loan, would may have been $5,000 in debt payments. I'm going to go and knock it down and get that principal down so I don't have to pay that interest. And that's a good honorable thing to do. We want to stay out of debt and be a strong business owner. And you're thinking you're making your business a solid business by doing that. That's more of that profit that's going to go towards paying down that debt. And then finally, he wants to reward himself a little bit, so pay himself six grand. I'm going to take a little owner distribution out. I've worked hard. I want to give myself a little pat in the back and get that $6,000. And suddenly, before we know it, he started with $67,000 in income, but his cash flow for the year is a negative $8,000. And he's ended up the year with less cash than what he started with. Okay? So we're going to talk about some of those concepts, some of the concepts we discussed here to help with this. Now, here's the one flaw I have with this report. I love this report, by the way. It tells a story, a great story about how a business is running. The one flaw is that for most of us in here, we own a business that doesn't pay tax. The business itself doesn't pay any tax. Our tax law says that income is going to flow, that $67,000 in income is going to flow through to my personal return. And so when we get in there and we start talking about that tax projection, and I tell the client, yeah, it looks like you're going to probably have to, we have $8,000 in additional tax we're going to have to pay this year because you had some good income. And then my client comes to me and says, I only paid myself $6,000. How the heck do I owe $8,000? Well, the reason is because you have this partner in your business. He's got 30% of it. And he wants his take, and his name is Uncle Sam. And Uncle Sam's not, unfortunately, because you're pass-through entities, Uncle Sam's not listed anywhere on this financial statement. And so we do, deal with those things. And that's frustrating. That's frustrating. When you feel like you're doing hard work, you feel like you're making some progress, you're doing all the right things, making sure that you're going to continue to sell the products that are selling, pay down that debt, and then you pay yourself modestly, and then you have a tax bill that's higher than what you paid yourself. Those are the woes of a small business owner. And that's why it's important to leverage your banker relationship, leverage your consultants that you have, and leverage the accounts that you've employed so that they can help you. They set terms up on the loans in such a manner so that you can cover Uncle Sam. Okay? You know, I like to say a banker loves to rent money. And that's really what it is, and you take advantage of that rent. And so we'll talk a little bit about some of those items out there. Anything else that you guys would maybe want to elaborate on cash flow that may be important to consider?
I think whenever you are looking at financing, we do get your P&L and your balance sheet, and we immediately use that to make this, the statement of cash flow. And that's what we base our loan decisions on. So it would be a good idea for you to work with your accountant to understand that when you go into a bank, so that you are aware of what the bank is looking at.
So let me ask you a question. How many of you finance some part of your business with a business credit card or personal credit card? Oh, come on. Most of us have done that. What's the interest rate on that? Anywhere, 18, 22%. So you want to pay that off quickly, right? What if your business is growing at a 15 to 20% clip? Now, do you really want to pay that off early when your business is growing and you need the cash? Because how many of you have hired an employee and it takes them maybe 2 months before they're kind of up to speed? So you kind of got 2 months of another employee's salary that's really not getting a return back in that revenue. You haven't jumped up there. So now you are expending money on payroll, paying the credit card company back, and your sales are not keeping up at the same pace. This is how you end up in a cash shortfall. And so everybody asks, what's the answer going? You talk to your banker. It is, you know, it's not that the debt was bad, the structure was not good for the situation of growth. This is why you talk to your bankers. And, you know, credit cards sometimes is the worst evil to do, but it might be the only one that's out there. That's why cash flow is looking at the past. This is where budgets come into play, of looking at cash flow for the future.
Yeah, to tail on that, it's important to talk to your banker before you go out and get all that credit card debt. You know, when we were preparing for this presentation, Dave and I, he was kind enough to hand this to me today on a sunny day. We talked about a Mark Twain quote in which a banker will lend you an umbrella on a sunny day. So, you know, don't go to the banker when you're all loaded up with credit card debt and you're paying 20% interest on all that stuff. The banker doesn't like risk. He wants to have some confidence that some things are going on. And communicating with your banker is so helpful. You need to explain, these are my plans, these are my challenges, and identify those things early on, not in the back end, early on. Same thing with tax planning. You can't come to someone in December and expect to get a whole bunch of tax breaks. You gotta get with them early on. And so that goes with you know, in terms of ways you're going to finance your business. So do we think that the Greg here in the donut shop, does he have good liquidity in his business right now? Yeah, he's taking current assets and paying down long-term liabilities. Right? He's really you know, messing up his liquidity by doing that. So let's talk about what are some unintentional what causes low liquidity from an unintentional standpoint. Of course, losses aren't good. The banker doesn't want to see losses. But when you're a startup and you properly plan, you're going to have losses, and that bank still may not lend you the money, but they can get a partner from the Small Business Administration that will help guarantee those loans. Again, the banker's about risk. And so, you know, there are ways the banker can reduce his risk, and if there are, such as working with a governmental partner that has infrastructure that can provide guidance to the business owners, yeah, a banker would borrow some of those losses. They just got to see that plan of how you're going to get out of those losses and how you're going to move forward from there. Sales growth. Greg the donut shop. He had to go out and get all that special chocolate from South America, right? So Greg may want to solve his liquidity problem by finding a local distributor of that chocolate, that same chocolate, in which he can get it delivered in a day or two versus 2 weeks, which means he doesn't have to buy as much, reducing his inventory and helping him out. For those folks that have receivables, you gotta have good business habits with respect to your receivables. You want to present that bill when that product has been sold, the service has been rendered, so they see the value, your customer sees the value in that immediately, and you increase your likelihood of having it in place. For inventory management, discuss that. You know, the product that's selling, moving off the shelf, start selling more of that product versus the product that just kind of sits. That helps. That doesn't help your inventory situation. Overbuying can be a problem too. Little techniques. The one's called the red line method, where you have your inventory on the floor, and as you start picking from it, you start seeing a red line. It's time to go buy some more inventory. All right. Some people use what's called the bin method. They keep 2 bins of the stuff. As soon as one bin gone, I'm going to go buy another bin. Anything else you guys would like? Is there bullet points maybe that I didn't include on this that you think would be helpful?
Understanding the seasonality of your business, a lot of businesses will build up inventory at the wrong time of the year and then be stuck with that inventory for a long time. So, watching what sells, like he said, is very important as you go through your inventory.
I'd like to add one item to that. Learning curve. I think that's another cause for unintentional low liquidity, learning curve. The mistakes of an entrepreneur over the course of the years, the mistakes that they make, causes your cash flow to be hurt. So I think that's an intangible that we don't, especially when I talk to entrepreneurs, young ones, they're just starting out, they have to prepare for contingencies because the learning curve is so great, and that's what can make or break your business.
Yeah, a good solution on that is sometimes looking for a peer group. It helps many times too, but it's true.
Well, I speak from experience,
The hard part, probably inventory for those that have products. If you're running QuickBooks is not a great inventory management system because it lumps everything all into one. And the most unfun thing to do is go do a physical inventory every year, when you might need to be doing it twice a year so that you are correcting what is your inventory so you can kind of balance those things. So if you've got a product with inventory, one of my suggestions is do physicals twice a year so you kind of, what do we really have? Because QuickBooks doesn't always charge things off unless you've got a POS system to kind of go along that ties directly into that. Most of the time we just lump everything into one inventory number and then we correct it at the end of the year.
One way you can help, I have it here a point on expansion of fixed assets. This is a place where you could leverage your banker. If you're going out buying some equipment and they got a security interest on the equipment, again, that's all about the risk. It reduces the risk and it helps improve the likelihood of possibly being able to get some financing on that from that standpoint. And the example I gave here is the business owner decided to buy the equipment with his cash, but maybe you should have thought about doing that. The other thing I didn't put on here is what we discussed earlier is sometimes paying down your debt early affects your liquidity as well. I don't know if you've noticed the trend, but when we're talking about cash management, we're not really talking about cash. We're talking about all these other things that are surrounding around cash. Cash management is a byproduct of managing these other aspects of your business. It's not necessarily looking at that register per se. Managing cash flow, a couple of things I bullet pointed up here, we've already discussed. Inventory management, break-even analysis, especially those businesses that are getting started or they're planning a large expansion or they're thinking about opening up a new branch or a new location. Do that break-even analysis. You got to know what is my revenue that I need to hit every single month so that I'm breaking even, so that I'm not having those losses. And when you're doing that break-even analysis, you need to think about paying yourself. That's got to be part of your break-even analysis. Who has fun starting a business up and not paying yourself? No fun there. We have in here speeding receipts.
Well, wait, back up. Do you have the formula for a break-even up there?
I don't.
Has anybody ever done a break-even analysis? A couple of you have. It's a very, very simple formula. Take your fixed assets, that's everything below your gross margin, that's your fixed expenses every month on the average. Divide that by your contribution margin. Your contribution margin is your gross profit margin. So in a month's time, if say my overhead was running $40,000 a month, my contribution margin was 50%, then the $40,000 divided by 50 is $80,000 is my break-even point. It's a very, very simple formula, but it's just one of those things of, oh, it's inconvenient to do when it takes just 2 minutes to kind of calculate what is it going into September versus what it is it going into December.
Some of you folks in here have been clients for quite a few years. At this point, your businesses are much more mature. But in the beginning, when we were working with you, we were doing that trending break-even analysis with a graph that helped you figure out, where do I need to be every month? What's my goal so I can get there? And as you matured a little bit, that's not as necessary as it used to be. But certainly that's an important thing to look at. It's an important thing to pick back up if you're thinking about doing an expansion of another location or anything to that effect. Never forget that it's out there. It's something you need. It helps you better understand what you need to do from an operational standpoint. Speeding receipts, taking credit cards. Okay, you may pay merchant fees, but where if you're in a position of low liquidity or you're trying to improve your liquidity, where are your priorities? One of those things may be, okay, well, I'll go ahead and accept those merchant fees so I can get paid quickly, so I can improve my cash flow from that standpoint.
I think the hardest thing is collections from your customers. Collecting. They never want to pay you, or nor do they want to pay you on time. So I think that's the most difficult. So I think that's a very important piece is the collection.
Having a collection plan in place is important, and making sure you adhere to it is important. It's billing timely, and products being delivered to the customer or the service. It's consistently sending out those statements. It's escalating into calls, letting the customer know how important they are to you, but they need to pay you. It's knowing when to turn them off, and it's also knowing when to send them collections. And more importantly, maybe when you mentioned what I think is the most important one related to before you acquire the customer.
Do a credit check.
Do a credit check.
Credit check.
Do a credit check.
Larger customers in particular. That's very important.
Make sure.
And I think we talk a lot about this during growth or during startup periods. And what happens is once you start really rolling and you're making money, you stop monitoring this. And that is a big mistake. You've got to keep monitoring this. So you are prepared and always planning. You can always improve, you can always review. So it's important for you to review these on a regular basis with your accountant and or your banker so that you are prepared and plan ahead.
I put bartering up there. Bartering is a two-edged sword. Okay? If you are a business in which a majority of your expense is payroll, you're probably not too interested in bartering because your employees want cash. They want chickens. Okay? They want cash. And so, that's probably not a good option for you. But if you're Greg at the donut shop and you're a little barter market, you can get chocolate, maybe something worth considering doing. Okay? Or, So it all depends on your own particular situation. Whether, the supplies that you need, you can get through a bartering exchange, that can be very helpful for you. But that's certainly one thing to consider.
Does that also mean bartering with the IRS?
Yeah, no bartering there either. They don't want chickens. All right, so we're going to move forward with respect to helping you manage cash. You know, looking back at this little PowerPoint that I put up here, and if there's anything I would do here is I would make that ampersand up at the title really big. Okay, budget and cash forecast. Now, when a lot of people think about a budget, they're thinking, okay, let me figure out my profit and loss, how's it going to look for the rest of this year. And I'll tell you what, not-for-profits are pretty good with budgeting. Small business owners, you know, that can be a hard thing to try to squeeze into your busy schedule. But it can be important to try to do that from that standpoint. But the cash forecast is important. You need to consider, as you're budgeting, you're assuming your sales are going to go up. You know, is my inventory going to have to go up to manage those sales? Am I going to have a growth in my receivables? And am I going to need to buy some more rack space in my warehouse? You know, those are very important things to think about and incorporate into your budget is the cash forecast, is how much cash you're going to need for this. And again, you go to consultant or banker, go through that process and have that discussion with them. It's important to have that discussion. I want to grow. And the banker wants that relationship. And he wants to see that you're planning that out adequately. Anything else? Any other points you think I may have missed out there? Anything to add or contribute?
Yeah.
Okay, things you can think about to help cash flow. Renegotiate with your vendors that you're buying from. That can be helpful. All right. Retaining profits. If you want to pay down the banker, maybe you shouldn't take that $6,000 out on your cash flow. Maybe you should retain it in there. And we'll talk about that. What is, and it leads us to the next stage, what is the appropriate amount of cash I need to keep in my business? What's the good amount of cash position? What's that safe level of cash I need to maintain? Okay? And I break down that cash balance into 4 categories. And they can be accumulating as you go. One is transactional balances. And you already mentioned it. Transactional balances is the cash you need to maintain the business operations. Doing payroll, buying inventory, making, knowing how quickly you're able to collect on your receivables. Those are all important aspects. And the key stat, we have a financial model, and we can work with you. If you have that question, ask one of our accountants in here. It's called the cash conversion cycle. And we look at all those aspects that we've been talking about today. Again, as I mentioned, the trend here is we're not talking about cash necessarily. We're talking about what affects cash. That's how you manage the cash, is by handling and managing those things that affect cash. And the cash conversion cycle is huge. It's understanding how long your inventory is sitting on the shelf and what impact that has on cash, how long the receivables are outstanding, what impact that has on your cash, all those different aspects. And you're going to need some equipment. Compensating balances. I define compensating balances as balances of cash that you may need to keep out there related to possibly a debt covenant agreement you have in place related to a loan. If you have a loan out there where maybe you've done a real estate expansion or you or done some sort of internal expansion in your business, the banker may say, hey, I want a reserve of cash. I want you to maintain a certain reserve of cash out there, and you got to show them once a quarter, once a 6 months or a year that you're maintaining that. So that's one of those aspects you're going to have to keep out there. And your compensating balance actually may be higher than the transactional balance that you have out there. Precautionary balances. Okay, from a personal standpoint, what do they say? You want to keep that rainy day fund, that 6 months emergency fund that you have out there from a personal standpoint? Well, a precautionary balance is that situation when you're in February, Greg's Donut Shop is in the middle of February, the blizzard comes through town, and he has to close down for 2 days, and then he's going to try to open up maybe for 3 days after that, but really no one's out in the streets, and he's still got expenses he's got to deal with. That covers those situations in which you've had a stoppage in business, and you need to handle that. And that's really going to be on your judgment, what you think that's going to be. What are my operating expenses for a week if I were to be shut down? And do I need to keep that balance out there as a reserve? And the last one I love, and we have some clients that do a really good job. She's not here today. We have a client, she's in the dental, she's got a dental practice. And she, I just love her. She's a really sharp lady. But every year in the dental industry, you have a big trade show here in Atlanta. And all the dental practices from all over the nation show up there. The vendors are there. And the vendors offer huge discounts for them to buy dental supplies at that show. And so she builds up a speculative balance out there so that she can go out there. She does it throughout the year. So she can go out there and drop some checks down and build up on her supplies that she needs for the year, which in turn makes her a much more profitable dental practice, which in turn helps her cash flow. And she'll have more money to speculate for the next year. Any other items?
No, the only thing I would add is sometimes these are separate bank accounts, not the same bank account, because it usually tends to be drawn out. So when your dental practice is probably setting that up, they're setting up a reserve. You know, most of us probably run a payroll account to make sure that we've got payroll coverage. To build in these contingencies, open up another bank account, start feeding it. Even if it's just $5 a week, feed it, or it won't get done.
Interest bearing account?
Used to be.
Yeah. 1/8. Very good point. All right, David, maybe you can bring some of your perspective on cash flow, cash management. Cash in general.
Yeah, and I'm going to stick the profile of a good borrower can really fall into so many things, but I'll stick to the cash flow and something that you talked about a moment ago is the debt service coverage ratio. And what we do with that is we take your cash flow, not your income statement, and we ensure that you have enough cash flow to cover your debt service. And that debt service cash flow, like he said, is not a one-to-one. We don't want the cash flow to just cover your debt service. We want a higher debt service coverage, which varies from industry and from the type of collateral, etc. It typically will be between 1.2 and 1.75 times your actual debt service. So we want to see that company, you know, after distributions, after taxes, after everything, still has the ability to service the debt and retain cash for all the other purposes, the reserves that are out there. So that is what we look for with the cash flow. When we are looking at a loan, you know, we have the collateral, we have the industry, we have, you know, issues about concentration, et cetera, et cetera, et cetera. But for cash flow, we want to see you have adequate cash flow for debt service and your reserves and building that.
Are you looking at collaterals personally as well?
Yes, quite often. With small businesses, we will look at both personal and business. It's not always going to be at the personal, but you know we are going to look at you personally for.
But for a startup, that's going to be probably primary.
Absolutely, because you are the business.
Yeah.
And that is just the nature of it. Another part he talked about here is alternate sources of funding. Like he said, banks don't want to take high risk, so we would look to partner with SBA, and what SBA does is affords a guarantee of default, would reimburse the bank to assist with that. And that's an excellent program, and I'll let, of course, Drew go into that into some more detail. And there's also called asset-based lending or factoring, which we have both in our bank and partner with other partners outside of the bank that help to manage your accounts receivable or your inventory. for those heavy inventory or heavy accounts receivable. And then, importance of cash flow statement. Like I said at the beginning, we take your P&L and balance sheet, and we use it to build a statement of cash flow. And that's what we base our decisions on. Not on your P&L, not on your balance sheet, on the cash flow. It's the most important thing. I'd say, like he said, cash flow, balance sheet, then income statement.
Yeah.
Hey, Chris, is that the #1 statement when you're trying to sell your business too?
Can be, yeah, absolutely. A lot of investors are going to look at a financial statistic. It's called EBITDA. That's an acronym for earnings before interest, taxes, depreciation, and amortization. And that's a measure they look at. What's the operating cash flow of the business before all those other activities? And they don't look at profit necessarily. They're looking at the EBITDA number, and it's a good measure of operating cash flow. All right, before we get into the questions, do you have anything you'd like to talk about?
Well, one of the things that I kind of specialize is, and I speak Bankanese. Did y'all hear what David said is debt service? What is debt service? When you make a loan, you actually pay the loan back in 2 payments. 1 part interest, 1 part principal. So debt service is those 2 parts. That's why 1 part of that payment, the interest, shows up on your P&L. The other part, the principal, shows up on your cash flow statement. That's why they kind of add back on this cash flow while they add back the interest, so they can take both parts when they're seeing that, so that people that are focused on cash flow servicing can see that ratio. That's why you really want to look at going, okay, if I had a loan and my loan payment was $1,400 more than I had last month, do you have $1,900 more in cash flow to support it? Because that's hitting that 1.5 to 1.6 debt coverage of what a bank is looking for. And that's pretty typical, is what Dave was talking about, is about 1.2 to 1.75. But every industry is different, and they have industry standards that they're looking at to say, what should the regular debt service should be?
Okay, I'll open it up for any questions. Anyone have?
I have a very specific question. It might be a fool's errand. I have a friend, and no, that's not a disguise. I really, it's not me. She's got a really unique business model that she's trying to get off the ground. Big problem though. She's never been a business owner before. She has some debt problems on her own personal side. However, she has a contract that is pending with a major company. The contract is pending on her going ahead and getting a small cash infusion. And when I say small, I mean high 90. So she came to me. I'm actually an insurance broker. She came to me about an insurance aspect. And I was like, dude, we've got bigger problems than insurance right now. So what would you suggest for someone with that profile? Again, not any investors, no capital to draw upon to keep in existence for the next 60 days, but has a huge pending contract over here from a major company. Would you just say, good job? Or any kind of resources for this person? Sorry,
I can answer that one.
gnarly ball.
It's going to be an alternate financing one. When we say alternative financing, there are kind of 2 factoring ones. You can factor on an invoice, and you can also factor on an order. And different companies will do these different things. Factoring on an invoice means that if they have a factoring division, they're assessing the credit of that person you extended that loan to customer. They're making sure that loan to customer is worthy. And so that's one other one. And a order is actually riskier than because they can cancel the order at any time. And so if you go and make your $90,000 worth of widgets, that customer go, we don't want them anymore. You eat them. Then where is it? So that's why those kind of alternative financing instruments usually have about a 5 to 10% interest monthly. And so you kind of factor that out for 3 months, you could be paying 60% interest? And I had that with one of my clients, that their first loan was at 48% because they did credit card factory. So they took all of their purchases by credit card from consumers and turned around and borrowed from their credit card transactions, which was a very expensive endeavor.
Never get off the ground. The other thing that this person needs to do is they need to have those three pillars. They need to have the banker, the accountant, and the attorney. And get those folks in place, involved. They'll be good advisors. And like I said, even if you don't use the account that much, pay the fees just to educate yourself. That's a good investment in yourself.
Not a good investment, it's a great investment.
So, even if the banker can't finance you, I'm sure the banker's interested in maybe referring you to a consultant, some of these organizations like the University of Georgia has, or referring you to some other alternate source of funding, because they want to maintain a relationship with you in case your business is going to grow, and there could be a relationship that can grow from that, and an arrangement can be set up later on. Any other questions?
Your relationship, when would I use you? When would I use you? And do you guys work together on stuff?
Absolutely.
You sort of think.
Yeah, absolutely. You can use both of us simultaneously. I'll let him go further into what he does, but he doesn't actually do the lending. I am still the bank and would still do.
So I go to him, he's gonna go to you.
That's correct. So
Okay.
he
We're
works.
gonna straighten things out with him, he's gonna say, this is what we need, this is how we do it, more as a consultant, and then we take everything from him and go to you.
Correct.
That's correct. And you're gonna have it put together and know he's gonna be the expert that's gonna have.
Absolutely. He's gonna help you develop that marketing plan.
Mhm.
He's gonna help you understand what kind of personnel you're gonna need. Okay, and really kind of develop that plan and start putting some numbers together. And then you come to the accountant for the accountant to put a litmus test on it, right?
Right.
Make sure it's not pie in the sky stuff before it gets over the bank.
So we have a written thing out with you, because you had mentioned, write this down, get this done, and take it over. So if we have a written plan with you two, we can take that and present it to the bank. That's fine.
Do you want to expand?
Sure. The SBDC is a program from the U.S. Small Business Administration. So as my favorite quote is, I'm from the government and I'm here to help. But here's the shocking part, is our services are free. Is that I've been doing this for 22 years. We do a lot of loan packaging, meaning putting that information together with you to take to a bank. In fact, most of the time people come to the SBC because their banker said, go see them. Or their accountant said, go see them. Because we like to send these things back out. We're not a lending source. So we have ongoing relationships with bankers, with CPAs, with attorneys, because this is our referral base. Give you an idea about that packaging. Last year, statewide, the SBDC helped small businesses put about $205 million into their businesses. So we are quite active in this packaging market. And basically all it's doing is putting the information together like banks want and kind of seeing, because, bankers usually are going to send us deals that says, we've got this, but let's just make sure. And I've done all sorts of deals. But I will tell you one thing is talk to your bankers. Talk to them. I just had a client that had a surprise property bill that she thought that it was being taken care of in her escrow account, and it hadn't been paid in 3 years. And all of a sudden the county came and said, you owe us $50,000. And then she got a demand letter. You got 30 days to pay $50,000. And she went through private sources, equities. I went, you need to talk to your bank. She says, oh no, I don't want to talk to my banker. They're not going to like this. And just like this. You need to tell your banker. Finally, it's 2 weeks before the deadline. I I said, have you talked to your banker? She goes, I'm seeing him tomorrow. She called me an hour later, says, the banker's going to do the loan. I said, of course they're going to do the loan. They don't want a $50,000 property bill lose their $1.5 million building. She held them kind of at ransom, but at the same time going, if you talk to your banker a long time, you could have saved a lot of headache. Bankers want what's best in your business. They are in it for the long term. Because if they do a short-term loan, they really want the long-term loans. They want long-term relationships. So if you do anything, talk to your banker, talk to your CPA, let them know what's going on. Because your tax return, if you were selling your business, is going to look very different than if you're growing your business. So if your accountant doesn't know this, they're going to prepare it as they would think you want it prepared if you're not telling them what are you trying to do. I'm at Kennesaw State. Our local office that services Forsyth County is in Lawrenceville. We have a campus, University of Georgia has a campus on Seaver Road that is just above Discovery Mills. And so everybody there does what I do. We have 45 consultants around the state. There's about 6,000 SBDC personnel across the U.S. and we all do pretty much the same thing. We just gotten really good at the financial part. And I'm a marketing person, and have gotten pretty good at the financial end. Because it's still probably the most critical piece that most of us don't understand. Is I deal with these cash flow statements all the time, and most businesses don't look at it. They don't understand it. It's kind of foreign. I don't understand depreciation and expense. Why is all this cash flow added back? It's reversed from what we normally see on our P&L.
Don't write a check for depreciation.
Now, we should require new businesses to have a certificate in financial management before they even start.
It helps, but the school of hard knocks teaches you.
Absolutely.
I wish there was a way to shorten the learning curve. You know, most of you are better because you did something wrong. And that's just how it is. We all do something wrong. It's not the mistakes you make. It's how well you recover from those mistakes. You ordered the wrong thing. You didn't really check out this customer. You spent too much hiring this person, or spent too long trying to find the right person when you could have found something else. Now understand, when you pay somebody $10 an hour, you're paying them $11.20 an hour. It's little things like that just you learn.
And it hurts.
It does hurt. It always hurts. I've worked with 5,000 businesses. I've seen every kind of thing, and it's exciting to see. That's why going to programs like this is so beneficial. It is, believe it or not, you're going to walk away with a better understanding about cash. Everybody knows it's cash, but if you walk away from one thing, the way to control cash is not with your checking account. It's with everything else that is not your checking account. That is why I love this series of how Chris put this together, is that you got to look at the other things that are not part of cash to manage the cash. And cash is king.
Very good. Very good. Agreed.
Anything else? All right. Thank you.
Thank you.
Quick question. It was stressed to check out people's creditworthiness. And I'd like to know what you recommend the best way to check out a business's creditworthiness without perhaps a D&B. You know, we can have them fill out a credit application and give us 3 references, but they're going to pick their best 3 references that they have. And you're not going to be able to make a determination if they really truthfully have answered, have I filed bankruptcy in the past? Have you done business under another customer's name? So what do you recommend for that?
Certainly D&B's out there. I don't know if it's as valuable as it once was 20, 30 years ago.
Yeah.
But I believe there are services out there that do maintain credit databases that may help. I think sometimes it's, you may have those references, and just my point, I'll let you guys elaborate as well. You may have those references, and I certainly would check them. Definitely go through that process and check them. But if you have any suspicion, ask for some financial statements. What will they say? No? Well, you have to take that into consideration, but certainly ask for some financial statements that you can look at.
Another one I would have is a banking reference, that they maintain a certain balance of some sort. You can request that. It's not, you can't, the bank's not gonna tell you what they keep and whether they bounce with them. You can say like, is this customer in good standing? And you can get that information from the bank with permission from the customer.
And limit the credit you're gonna give them. If you feel that the credit isn't that good, but you still would like the business, well, let's take some small steps. And we're gonna limit the order size, and we'll make sure you're gonna pay. And once we receive payment, we'll continue for that a little while and let you build credit with us. That's another option. Do you have any thoughts?
That's exactly where I was gonna look, was checking their creditworthiness with their bank.
Okay.
So ask for the bank reference, ask for the account number on your credit application. Gives you a lot of information to go and look at. A lot of small businesses, you're dealing with another small business, and it's hard to find business credit out there. D&B used to be the great database, but it's not as strong as it used to be. But that's when you start looking at the other service bureaus, the Equifax, TransUnion. They have credit history kind of connected with that. But it's even getting harder because effective July 1, certain credit, bad credit is not reported on a personal credit report. Medical, non-payments, let's see, liens are no longer reported. So this is getting harder for a banker and mortgage companies to figure this stuff out, because this would be great for the recovery business, because there's going to be credit extended folks that probably shouldn't. Kind of reminds me of what 2007 was like.
Right.
Because that's what created the whole crisis that was in there. So this is one challenge that's going on, is some of the information that used to show up on a personal credit report do not show up anymore.
The problem with that is if they say no, you're gonna say, okay, I'm not gonna take your money. I mean, a lot of us are gonna probably take their money, right? That's just the reality of small business. You know, to try to get credit checks on every one of your customers, and they say, hey, I don't wanna do that, then what, you don't do business with them? That could hurt your business as well. So I know it's kind of a happy balance.
It is.
It is, and one way is to, let's limit the orders. We'll start slow. We check your credit, we see, it's not the best, we see some kind of blemishes there. We want to do business with you, so let's just start with some small orders, and then we'll work our way up, and maybe you can build some credit with us. That way, I understand that balancing act that you have to maintain. Awesome.
Chris, on that same thing, when that case is okay, yeah, we do business, but we'll take it on credit cards. Okay, yes, you lose a little bit from taking the credit card, but the risk is his problem, not yours.
Absolutely. That's an amount that you're willing to pay to mitigate your risk.
And one other thing you had up there was, I can't remember exactly what it was, but speeding up receivables. And it's funny, but I used to do it in another company I worked at, is we would send out statements on the 1st and the 15th. And the customers, and we'd send the statement out, it would be just like a monthly, end of the month statement. But it was amazing the number of customers that normally would have paid on the 30th, when they got that statement, they paid on the 15th. That increased probably about 23 or 24%. Money came in faster.
The key on that, it really is.
You notify them.
Yeah, it's about the process. Define what your process is going to be, like you did there, but being consistent with it and following through with it all the time will do wonders for your collection efforts.
Remind me of something to do on that credit report for the credit application that you have. Ask for your customer's account payable person in their email. That's who pays the bill. Not the owner, not the manager, the accounts payable clerk. Get to know that person. That administrative position is one of the most powerful ones in a company. They decide who gets paid.
All right, we're running out. I know everyone's busy. Got to get back to work and to your businesses. I appreciate you coming out. Thank you so much. Be sure on the way out, grab a little picture by our man over here who's eyeing us with the cash. We want to see if we can get some pictures out there on social media. And yeah, or a picture with me. There you go. We want to just kind of promote this thing on social media if we can, and or if you don't want a picture taken, I understand. But thank you for coming out.
Yeah, thank you.